Welcome back to Deep Dive Cuttlefish. We're plunging into the market buzz again, trying to surface what you really need to know.
And then there's definitely been some buzz lately.
Yeah, something pretty dramatic sounding happened in mid-April 2025. Both the S&P 500 and the Nasdaq 100 saw a death cross.
That name certainly gets your attention, doesn't it?
It really does. And the market felt it too. The S&P dropped almost, 19% from its peak. A lot of that seemed tied to the renewed U.S.-China trade tension stuff.
Right, the whole tariff situation flaring up again. And it was the S&P's first death cross since early 2023, so it naturally got people talking.
So maybe we should quickly break down what a death cross actually is, technically speaking.
Good idea. So at its heart, it's pretty simple. You've got the 50-day moving average. That's like the average price over the last 50 days, gives you the shorter-term trend.
Yeah.
And that line crosses below the 200-day moving average, which, shows the longer-term trend over the last 200 days.
Short-term momentum dropping below the long-term picture.
Exactly. And the reason for the scary name is that it might mean a little pullback is turning into something, well, longer and more bearish.
Got it. Now, for you listening, you're part of the Deep Dive Cuttlefish community, so you want more than just the scary headline, right?
You want to understand what it actually means.
Precisely. So our mission today is to really unpack this death cross. We've gone through a pretty detailed report, pulling together historical data and what various market experts are thinking.
Yeah, to figure out how reliable the signal really is and what the pros are saying about this specific instance.
Okay, so let's start with that big question. When we see one of these, how worried should we actually be? Does history give us a clear answer?
Well, that's the interesting part. History is kind of mixed on this one.
Mixed how?
The report shows it's not really a perfect predictor. I mean, sometimes, yeah, it definitely came before more significant drops.
Okay.
But other times, it actually showed up after the worst of the selling was already done.
So, like a lagging signal sometimes?
Exactly. Looking at the S&P 500, say, over the last 50 years or so, there were 24 death crosses.
Right.
And get this, and about 54% of those, so, more than half, the actual lowest point the market hit in that correction had already happened before the death cross signal technically triggered.
Huh. So it was confirming bad news that was already kind of priced in.
Sort of, yeah. But you can't ignore the other side. In the other 46% of cases, the market did keep falling after the death cross.
And how bad was that?
The average additional drop in those cases was pretty hefty, around 19%.
Ouch. Okay, so those are the ones people remember. Any big examples?
Oh, yeah. The report flags a few. Think late 2000, the dot-com bust, death cross happened, S&P fell another 45% after that.
Wow.
Or late 2007, just before the global financial crisis really hit. Same thing, death cross. Then another 55% drop.
Okay, those are scary.
And even more recently, early 2022, we saw a death cross around the time the Fed started hiking rates aggressively. That definitely marked the start of a bear market.
So what's the common thread in those really bad ones?
It seems like the death cross wasn't happening in a vacuum. There were huge underlying issues, like the tech bubble in 2000, the whole financial system being shaky in 07, 08, or that big policy shift against high inflation in 22. The death cross was a symptom, maybe, but the disease was fundamental.
Right. Context matters. So what about the other times, the ones that weren't preludes to disaster? Especially maybe more recently.
Yeah, if you look just since, say, 2009, after the GFC recovery started, the picture's a bit different. Most death crosses in that period didn't lead to those massive drawn-out declines.
Right.
In fact, I think it was 5 out of the 7 times since 2009, the extra drop after the cross was less than 7%.
Much more manageable.
Yeah. And like we said, often the market low was already in the rearview mirror by the time the cross happened.
What about performance after the cross? Does the market tend to bounce back quickly, or does it languish?
It's nuanced. Right away, like in the first month, it's a bit of a coin toss, maybe slightly more likely to be down. The median move was about minus 0.9%.
Okay, so some immediate weakness is possible.
But then it tends to improve. Look out 3 months, and historically, the S&P was higher about 85% of the time after a death cross. Median gain almost 6%.
Interesting. And further out?
6 months later, usually up, median gain around 10%. And 12 months out, higher about 6 out of 7 times with a median gain of like 15%.
15%, that's pretty solid.
Yeah, and the report mentioned some LPL financial research going way back to 1950. It showed positive average returns 3, 6, and 12 months later, too. Market higher about 72% of the time after a year.
Okay, so summing up the history lesson. It's definitely not a guaranteed crash signal, mixed record, often lags.
Exactly. It's not game over. But you can't totally ignore it either, especially when those big downturns happened. The why behind the sell-off seems really crucial.
Right. So that brings us to now, mid-April 2025. Given that mixed history, what are the experts saying this time? Is it a warning sign or maybe even a buy signal?
Well, you've got opinions on both sides, as usual in the market.
Let's hear the optimistic case first, the don't panic view.
Okay, so the bulls, they're leaning heavily on that history we just talked about. They say, look, statistically, you've actually been better off buying after a death cross than selling.
Ah, the contrarian angle.
Sort of. Adam Turnquist at LPL Financial is quoted saying pretty much that better off a buyer than a seller. He points to those positive average returns over time as a reason to maybe see this as an opportunity or at least, hold steady if you're a long-term investor.
And they probably emphasize the lagging indicator part too.
Absolutely. That's a key argument. The cross only shows up after a chunk of the decline has happened. Like the bad news might already be baked in.
Like declaring a recession months after it started.
Yeah, exactly like that. Someone in the report made that comparison. And they point to signs in early April 25, volatility spiking, sentiment getting really negative as maybe signs of capitulation, like the selling was exhausted.
Capitulation, like throwing in the towel.
Right. Turnquist even mentioned the possibility of V-shaped recoveries like we saw in 2018 or 2020, where the market snaps back pretty fast.
And does the cause of this sell-off factor into the bullish view? The tariffs?
Definitely. They tend to frame this as event-driven, triggered by the tariff news rather than something fundamentally broken in the economy. Ed Yardeni, for example, acknowledged the cross, but also highlighted a positive signal called the Zweig breadth thrust in mid-April.
What's that, in simple terms?
Basically, a lot of stocks suddenly started moving up together strongly, often a sign a rally could be starting. Yardeni's still forecasting the S&P much higher by year-end, suggesting he thinks this is a temporary trade-related blip.
Kind of like late 2018. That was also about trade and Fed fears, wasn't it?
Yeah, good comparison. That turned out to be a sharp correction, but then a strong recovery followed. The bulls are hoping for a repeat.
What other potential positives are they pointing to? Reasons for a rebound?
Things like maybe the trade dispute gets resolved or at least cools down. Maybe the Fed steps in with some support if growth really slows. Maybe inflation eases later in the year and earnings pick up in 2026. The core idea is this is a shock, mostly sentiment-driven, not a fundamental collapse.
And if that's right, then maybe the extreme pessimism itself is a buy signal.
That's the contrarian play, yeah. When everyone's super bearish, sometimes the worst doesn't happen and you get outsized gains. So the death cross becomes almost ironic, a signal to buy, not sell.
Okay, interesting case. Now let's flip the coin. What are the bears or the more cautious folks saying? Why should we be worried?
Well, they start by saying, hang on, let's not forget those times the death cross did precede major trouble. They point right back to 2000, 2007, 2022.
The recessionary periods.
Exactly. They argue that ignoring that precedent is risky, especially if you think today's economic backdrop has some worrying parallels. SoFi research even found death crosses before the really bad ones, like 1929 and 1974.
Oof, okay.
Their main point is that this might not be just a routine pullback. They see potential for structural risk.
Structural meaning?
Meaning problems that could genuinely damage growth and profits long term, not just a temporary scare. And the big one they point to is the trade war stuff.
The tariff impact.
Right. Investing.com was quoted saying the tariffs are fanning the flames of recession fears. And we are seeing some real effects, right? Companies like Walmart pulling earnings guidance, analysts cutting profit forecasts.
Yeah, those headlines have been around.
So the bears worry this could become structural if the trade war really bites, or if policy mistakes damage confidence, maybe pushing us into a real recession later in 2025. Then the death cross looks less like a lagger and more like an early, accurate warning.
Makes sense. What about the pure technical picture from the bearish side?
They see the death cross itself as creating overhead resistance. Like now the 200-day average is above the 50-day, it acts like a ceiling, making it harder for prices to rally sustainably.
Like pushing against gravity.
Kinda, yeah. Lance Roberts, an analyst mentioned, talks about this hindering rallies. Plus you have automated trading systems, trend-following algorithms. Some of them might be programmed to sell on this signal, adding pressure.
Does data back that up short term?
Bank of America data cited suggests slightly better than even odds of more downside in the first 20 trading days after a cross. The average loss wasn't huge, like made it go 0.5%, but still it points to near-term weakness and volatility.
And the market did flirt with that bear market level. around 4,900 on the S&P.
That's a huge point for the bears. Getting close to that 20% down mark is psychologically important. If the market were to break below 4,900 decisively and stay there, that would confirm a bear market technically and likely trigger more selling.
So the core of the cautious argument is maybe the headwinds trade, Fed policy, geopolitics won't just go away quickly.
Exactly. What if we get stuck with slow growth and high costs? That's a toxic mix. Investors might just keep de-risking. And even after the drop, valuations aren't screamingly cheap if a recession is coming. Forward PE around 19x.
Still kind of pricey if earnings are about to get slashed.
Right. So the bottom line for the bears is maybe the market is sending a valid signal here. Maybe there is trouble ahead.
Okay, so we have these two distinct perspectives. How does this translate into practical implications for you, our listeners, depending on your investment timeline? Let's start short term, next few weeks or months.
Right, the tactical view. Well, first off, expect more choppiness. Volatility is likely to stick around.
Ups and downs, whipsaws maybe?
Yeah, very possible. And as we said, there's still that historical 40–50% chance of more downside in the near term. That S&P 4,900 level is really key support to watch.
So caution is warranted. Maybe hedge or avoid too much leverage.
Seems prudent, yeah. As long as that 50-day is below the 200-day, there's that technical headwind Lance Roberts talked about, negative price pressure.
But are there things short-term folks should watch for that might signal a bottom is forming?
Definitely. Keep an eye on those things we mentioned earlier, that breadth thrust signal, the bounce off the lows. Also look for volatility, like the VIX index, to really calm down and stay down. Watch credit markets. Are they stable? And critically, can the index reclaim key levels, especially that 200-day moving average?
If it gets back above the 200-day, that negates the death cross signal, technically.
Exactly. And remember Turnquist's point about things often looking better 3 months out. So short-term traders need to be vigilant, manage risk tightly, but also be ready to pivot quickly if positive signs emerge.
And catalysts are key short-term too, right? News on
Yeah.
tariffs, Fed signals.
Huge. Any positive news there could change the game quickly. It really makes trading around a death cross tricky, requires discipline and staying glued to the news flow.
Okay, so short-term, cautious, watchful, nimble. What about for long-term investors, people looking out a year or more?
For the long-term crowd, the message is generally quite different. The main takeaway is death crosses historically have not been reliable signals of long-term doom.
That stat about the market being higher a year later most of the time.
Right, around 70% of the time, often with double-digit gains. You have to remember the overall upward trend of the U.S. stock market over decades. Sell-offs happen, even scary-sounding ones, but the long-term trajectory has been up. Reuters noted many past death crosses were followed by quick, V-shaped recovery rallies eventually.
So for long-termers, could this actually be an opportunity?
Many pros see it that way, a chance to rebalance, maybe add to positions at lower prices. That contrarian buy signal idea again. LPL's backtest favored buying. We reportedly saw insider buying and retail dip buying increase too.
So strategies like rebalancing, selling some bonds, maybe to buy stocks or dollar cost averaging, could make sense.
Potentially, yes, if it aligns with your long-term plan and risk tolerance. The key is sticking to your strategy.
But even long-term investors need to keep an eye on the fundamentals, right? It's not just close your eyes and buy.
Absolutely. The bullish long-term case hinges on avoiding a really deep, protracted recession or some kind of financial crisis. So you still need to monitor earnings growth, interest rates, geopolitics. Giardini's roaring 2020s idea is optimistic, but even he notes the recession caveat. You need to be clear on the assumptions.
So the main advice is discipline. Don't panic sell based on headlines.
That seems to be the core message. Focus on the long run. Don't overreact to the death cross itself because its predictive power is limited. Remember, 2020 panic selling was costly for many who missed the rebound. Maybe use the dip to upgrade portfolio quality rather than just bailing out.
Okay, that makes sense. So pulling it all together, what kind of strategic adjustments are pros actually making, and what's a reasonable base case outlook?
Well, it doesn't sound like a mass exodus, more like a risk review. Professionals might be trimming leverage, cutting back on highly speculative stuff if they were overexposed.
And value guys might be looking for bargains.
Exactly. Quality stocks, maybe tech or semis that got hit hard, could look attractive to them. The general theme seems to be stay invested, but maybe tilt towards resilience, strong balance sheets, reliable cash flows, maybe more defensive sectors.
And any short-term tactics.
Yeah, things like using options for hedging, setting stop losses, but again, probably caution about making huge bets against the market given that rebound potential. Doesn't seem like a consensus short and hold moment.
So what's our base case outlook?
Yeah.
Based on everything? Cautious optimism.
I think that sums it up well. Death crosses mark challenges, not necessarily long-term doom. Short-term, say the next 1-3 months. Probably still bumpy, range-bound, maybe testing lows again until we get clarity on trade and the economy. Plausible to see swings.
But the underlying assumption is we avoid the worst-case recession.
That seems to be the base case, yeah. Assuming some kind of tariff compromise or central bank support if needed. If that holds, then maybe the second half of 2025 sees a gradual recovery.
Making the death cross a contrarian buy signal in hindsight, like 2018 or 2020.
That's the optimistic path. And maybe 12 months out, the S&P is actually higher than it was before this whole correction started.
But big caveat, that depends on those assumptions holding up.
Absolutely critical. Trade war de-escalates, slowdown is mild, inflation behaves, Fed has room to act, earnings recover by 2026 if those assumptions fail.
Then the downside scenario plays out, and the death cross was a serious warning.
Exactly. Then capital protection becomes the name of the game.
So the bottom line, be aware, manage risk, especially short-term. Long-term, maybe see it as volatility and potential opportunity, but stay focused on fundamentals and your own plan. Vigilance, diversification, measured steps.
Well said. And the insights we discussed came from analysis incorporating views from Reuters, Business Insider, Investing.com, eToro, Yardeni Research, LPL Financial, and others.
Okay, so thinking about this now through our Deep Dive Cuttlefish lens, focusing on investment insights. What does this whole analysis looking at a technical signal within its economic context suggest for how you might approach your own investment decisions right now?
Yeah, does this deep dive make you reconsider certain sectors or asset classes, maybe want to explore some areas further?
We genuinely love to hear your take on this death cross. Are you concerned, or do you perhaps see opportunities emerging? What other signals or trends are you watching closely?
Drop your comments below and let us know if you have ideas for future deep dives investing related or anything else you're curious about.
Because that's what we aim for here at Deep Dive Cuttlefish, providing that in-depth analysis to help you make sense of the complex stuff. Hopefully this helps shed some light on the death cross situation.